QQQ, also known as the Invesco QQQ Trust, is one of the most well-known and widely traded ETFs in the world. It tracks the Nasdaq 100 index, which includes the largest non-financial companies listed on the Nasdaq stock market. When people think of tech giants like Apple, Microsoft, Amazon, Nvidia, and Meta, they are thinking of the core of what QQQ owns. This ETF gives investors instant exposure to the innovation backbone of the US: economy, technology, e-commerce, biotech, and communication. Let's start with the payout tracker. QQQ is not known for its dividend yield, but it still pays a quarterly dividend. As of 2025, QQQ pays around 60 to 70 cents per share every 3 months, which adds up to roughly $2.50 per year. That comes out to a dividend yield between 0.5 and 0.7% depending on the price. This makes it less of an income-focused ETF and more of a capital appreciation vehicle. You are not buying QQQ for the dividend, you are buying it for long-term growth. And over time, QQQ has delivered exactly that. Now let's break it down with the income table. If you own 100 shares of QQQ, you will receive about $65 per quarter, or $260 annually. Owning 500 shares gets you approximately $1,300 per year. 1,000 shares earns around $2,600 per year. Again, this is not for passive income lovers. It is for growth investors who want exposure to some of the fastest growing companies on Earth. Next up is the net asset value and performance. As of July 2025, QQQ is trading around $460 to $480 per share. That is a massive climb from where it was just 10 years ago. In the last decade, QQQ has returned more than 300% total return, far outpacing the SP 500 and the Dow Jones Industrial Average. The ETF holds 100 companies, but the top 10 holdings make up more than 50% of the fund, with Apple and Microsoft each accounting for over 10% on their own. This heavy concentration in tech means QQQ moves fast, both up and down. Let's compare it to similar ETFs. If QQQ is the high-octane sports car of growth investing, SPY is the balanced sedan. SPY tracks the SP 500 and has a broader sector mix. Meanwhile, VGT, the Vanguard Information Technology ETF, focuses only on tech and has an even higher tech weighting than QQQ, but it does not include other growth names like Amazon or Meta. For investors who want a little less volatility but still want tech exposure, QQQM, the Invesco Nasdaq 100 ETF with a lower expense ratio, is a cheaper alternative with the same holdings. Speaking of expenses, let's talk fees. QQQ has an expense ratio of 0.2%, which is higher than most index ETFs. That means for every $10,000 invested, you pay $20 per year in fees. While that is still low compared to mutual funds, it is double what you would pay with SPY or VOO. However, the performance of QQQ has more than justified the higher cost for most investors. Now let's talk about volatility. QQQ has a beta of around 1.2, which means it is more volatile than the overall market. When tech rallies, QQQ surges. But when tech crashes, like it did in early 2022, QQQ can drop fast. This is not the ETF for someone who panics at a 5% dip. It is designed for people who understand long-term investing and are willing to stomach short-term swings. Let's discuss risk and sustainability. QQQ's biggest risk is concentration. More than 50% of the fund is in just 10 companies, so if those top names stumble, QQQ takes a hit. It is also highly sensitive to interest rates. When the Federal Reserve raises rates, high-growth tech stocks often get hurt the most, which trickles down to QQQ's performance. That said, the companies in QQQ, Apple, Microsoft, Amazon, Nvidia, are some of the most dominant, profitable, and cash-rich firms in the world. They are not speculative bets, they are global titans. Next is the exit strategy. QQQ is perfect for long-term investors with a 5-year or 10-year time horizon who want to participate in innovation. It is not something you want to day trade unless you are an advanced trader using leverage or options. For most investors, buying and holding QQQ through market cycles and reinvesting dividends along the way has proven to be one of the most effective strategies for long-term wealth creation. Now for my meter rating. Income, 2 out of 10. The dividend is small and not the main reason to own this ETF. Risk, 7 out of 10. High volatility and concentration risk make QQQ more aggressive than most index funds. Sustainability, 8 out of 10. The companies it holds are financially strong, innovative, and likely to be around for decades. Upside potential, 10 out of 10. Few ETFs have outperformed QQQ over the last 15 years. Ease of ownership, 7 out of 10. It requires patience and the ability to hold through sharp corrections. Final total rating, 8 out of 10. QQQ is not a boring fund. It is growth-heavy, tech-dominant, and fast-moving. But if you believe in the future of artificial intelligence, cloud computing, electric vehicles, and digital transformation, then QQQ is one of the best vehicles to ride that wave. It is not about collecting dividends, it is about compounding capital with the most disruptive companies of the next century. If you have any videos you'd like me to cover, say it in the comments below and I will break it down in plain English.